would be difference in the total income. Now, interesting comes is is a question when what happens that if the taxpayer himself finds that where there has been dealings between in the context of 482 where the pricing has not been done on an arm's length basis, and if he was to make a voluntary addition in the return of income. So here again, what we're trying to comparing with the earlier and now, that if the just to show that what is the difference when the dealing is with between an eligible and a non-eligible unit and dealing with a person who is covered by 482. I'm just trying to differentiate what would be the impact. So here, if the purchase is from the related party, the gross total income is 200, and assuming that the assessee is entitled, the entire profit is exempt under 10 average, the taxable income is nil. However, if there is a dealing with a related party, and there if we find that the payment was on the higher side, and therefore 20 ought to have been disallowed. If the taxpayer was to himself make an addition in the return of income of that 20, then in that situation, it seems that he is entitled to that because that will only increase the 10 double income. But if he makes a suo motu adjustment, it seems at least from the wordings of the section that he will still be entitled to deduction under 10 double A, because what the provision says that where after the order is passed by the TPO, if there is an adjustment made, in that situation, that differential is not eligible for the incentive. But if the taxpayer himself, and we have, of course, we have IGATE situation, we have the decision of IGATE, which was in the context of revenue, where the revenue was computed higher than what was actually received, and therefore the taxpayer made that adjustment and he paid. And we also have, I think, Deloitte's decision, but that's again on the expenditure side, and this is somewhere near to that, which is a contrary decision of the Mumbai Tribunal. So currently you have a Bangalore Tribunal which is in favor, which at least accepts this principle, but we have a Mumbai Tribunal in the case of Deloitte which is again. So one will have to be careful, but at least I think from a plain reading of the law, it seems that this position, at least the wordings of the section support this proposition. I was just trying to differentiate what can be the impact ultimately when you are dealing with an eligible and non-eligible units, and when you are dealing with in a 482 situation. So going from any questions around 8I, because then then we'll move to 8I 810. Capital account transactions, if the movement is in the ordinary course of business, as I mentioned, that if the movement is in the ordinary course of business, then the STT will trigger. But here there is no question of, it's not like a 482 where only expenditure is covered. So if capital goods, there is a movement of capital goods, the question on depreciation claim will come. So in my view, I think one will have to. See, here the question will come. In fact, I have one case study. Let's take a situation where there are no transactions, okay, which are clearly covered within the provisions, and there are only allocations, what we saw, and those allocations are exceeding say 5 crores for whatever reasons. In my view, I think from a penalty perspective, may be advisable to do the compliance. Okay, but when you fill up your form, etc., you will say, my view again, that one will have to say no, these are transactions which are not covered with appropriate disclosure, because I think your 2% penalty is very harsh. So if you have situations, so yes, there will be various situations. If I take a position that HO allocation is not a transaction, SDT in that sense required, but if I have to make that allocation and then the amount crosses 5 crores. So I think there will be various situations, but again, I think one will have to take a judgmental call.
In the year of capital expenditure, whether these provisions will be applicable in the year of expenditure or in the year of trading depreciation?
No, as far as so when you are saying that if the non-eligible unit, okay, has actually sold some asset to the eligible unit, and if for reasons maybe it's in which situation that I will not claim a depreciation.
It's in the capital work in progress. What is trying to say?
Okay. No, then I think in the next year it should happen. But what will happen, I'll tell you. It's again, and that we face in our international also. Somewhere, so what is that you are going to justify? What you need to justify is actually the cost. So it's better to do the compliance in the first year.
In that year, I am not claiming say API.
No, I agree you are not claiming. What I am saying, what you need to justify is the cost of the asset, the purchase price. Because depreciation is then is a consequence, no? Because it is not there. Because if you have paid a higher cost, your depreciation claim is going to be higher. So it's better to do the benchmarking and compliance in the year of purchase. And then you can follow it in whenever we have started claiming, and you can rely upon. Because at that point of time, I don't know how you will do a benchmarking for the cost which was incurred 2 years back.
In such a situation, whether these provisions will apply, because these are the independent years. So in the first year, it's a capital expenditure, so not applicable. In the second year, when the deduction is claimed at that time, you can say it's a depreciation.
No, that's exactly what I am saying. I am saying you benchmark the purchase price in the year itself, I am saying. That will help you when you are claiming the depreciation. Because then otherwise there could be a situation you will never comply. No? In what you are saying that you will never comply in any of those years, which is incorrect. Because that cost is relevant. See, for example, in international, say suppose you buy shares today. Okay, there is right shares or whilst let's not get into the Vodafone and share category. Okay. When shares are typically or when you make investment, okay, you say that PP does not apply because there is no income arising. Right? I'm talking from the investor's perspective. Okay? After 3 years down the line, you sell it to third party. Then you will say you will never comply. It will always be there because that initial investment cost you will in any case will have to pay. Right? So it's always advisable that in that year of transaction only you at least have the cost benchmarking or that ALP done. So you are therefore not asked questions on the cost and later. Okay, coming to 8II, 810. Again, it needs to, of course, contrast to 8II, it has to be some other person. I think the two things that comes is that what is the trigger for invocation? Assessee, of course, has to carry on eligible business, and if it appears to the AO that owing to the close connection or otherwise, the business is so arranged that the transaction produces more than ordinary profit in the tax holiday unit. And again, it is, of course, the consequent amendment that wherever STD has to apply, then the arm's length price will have to be computed as provided. So this is actually kind of a double edge in that sense that the scope is not restricted to good or services and also not restricted to 42 persons. And wherever if the revenue is more than ALP, does imply existence of more than ordinary profits. So I think let's, if one reads the section, in so far as it relates to transactions which are STTs, one will have to do the ALP. If it is not, then you will still go to the existing provisions. And that becomes important when you are doing the benchmarking. And benchmarking, how do you do? Because all of us know that when it comes to STT, we have the prescribed rules, methodology, average, a simple arithmetic average, and you have your up to 3% of the range which is available to you. But if you don't fall within STT, the close connection has a wider meaning. And today also we do what we mean by ordinary profits, and ordinary profits in that situation strictly are not required to be done in the way you do from an ALP perspective, because there could be extra circumstances, external circumstances also which will be leading, etc. But it's not a straight jacket formula. So just to take this by way of an example, here you will have that A and B are related parties, and B has a tax holiday unit, and there are transactions between A and the tax holiday unit. So here, from A's perspective, ET will not be applicable because for them it is a revenue transaction. We are all clear. But when it comes to B, the payment is to a party which is under fortile to B, because clearly it is the parent in that sense. So therefore, it will trigger STT, clear. But payment is at fair market value and less than fair market value, so therefore no TP adjustment really necessary. But when it comes to 8I-10, may still be invoked on the ground that the arrangement leads to more than ordinary profits. I think that will be the question that I think we will need to answer. So just let's again look at what is 8I-10. Close connection, we know that close connection is much more wider than, because there are fortile to B, it will go beyond fortile to B. More than applicable profits and applicability to loss. Again, my view, yes, profits will include loss, so therefore less than ordinary losses will have to see. And then the challenge will come, how are we going to do the benchmarking? And all of us know that our last resort is TNMA. Now in TNMA when we will have to do, I don't know whether I will have to find average of the losses, loss-making companies, or those are going to be loss-making and profit-making companies, because we are never be able to find comparable data of eligible units. It will all be at the entity level. So I think this is going to be the biggest challenge. And honestly, also there is no straight answers to this. Concept of ordinary profits wider than LLP, I don't think anyone has doubts about that. Applicability to capital expenditure, yes, I will again say yes, it will be, because as I mentioned, depreciation, one of the examples is that yes, depreciation will get covered. Sorry? My goods can only, goods or services, goods will be capital goods also. If I am selling, it's capital good for you when what I am selling is in my ordinary course. I may be a manufacturer of machinery, and what I am selling to you is machinery. For you it is capital goods. So can you repeat that? And here also, if you will see in 8 and 10 again, and if you have to look for it, see it says the course of the business is arranged, and business is much more wider concept. It will include everything. What it says is because of the close connection, the business is so arranged that it gives them, which is much more wider concept. And if it comes to fortieth to related question, then so clearly it is the purchase, right? Because then you will have to go back to if it gives you more than ordinary. Yes, sir.
Then when you mention that close connection is wider than 48 days, you are not defined. Can you give an example that what is will be included in close connection which is not included in 48 days? A few examples.
Sir, I will, okay, let me take some clue from our international transactions. We have seen that where one entity is buying raw material which constitutes 90% of its raw material requirement. What is it? Somewhere. You have whereby someone has given you loan which is more than 51% of your gross value of your assets. Are some of those things? I don't know. I'm just saying.
So the artificial meaning of associate enterprise for the purpose of international transaction.
Would it apply for the purpose of API?
Then what I'm saying, what would be otherwise a close connections?
I have asked you.
No, that is what I'm saying. I said earlier though it was not. Now today you have some clues, I'm saying.
The normal interpretation is that the fiction should be limited for the purpose of section for which it is created.
No, I agree with you, but this section has been there. Now it has not been invoked so much. But now it may get invoked. Say for example, earlier that 19% was as 20%. We know that 20% is a threshold for our SPTs, right? Now what happens if it is 19%? And I think it is two things. One is close connection and the course of business is so arranged. I think both will have to go together and each phase will have to be seen. Because in some of the arrangements, you will yourself get convinced that yes, it is leading to some kind of. There may be some pro or some kind of contextual set of happening. It can happen. So I agree. Yes, we will come to it. Yes, it will come into law. Yeah, it will come. Once you start claiming, okay, of course it is there, but since time is also, I can jump to that. You have sections whereby after 15 years you can choose 10 years, and you may choose all of not those 10 years. But once you have got into the initial year, okay. And then subsequently, if there are losses, etc., those losses will have to be set off. Then you again come into the profit and you start claiming it. So therefore, you will have to very clear.
Same thing will apply to ETI also.
Absolutely. Absolutely. Very well. Absolutely.
First you give initial and thereafter, no?
Yes. Yeah. Once.
Initially it is not.
No. Because you are not going to. Absolutely. And there also only for the eligible expenditure. Only for the eligible expenditure. I agree.
And why should the SSCP say that I want unreserved profit?
No, I'm saying you will have to end of the day support that. Huh?
I will support by my transparent document.
Agree.
I should not discuss this in the CEB report.
Yeah, if you believe so. So again, let's come to this on so where again you have a company which has two subsidiaries, and the first subsidiary has given loan to the second subsidiary, interest free loan. What will happen the context of again 8 and 10. And there I think the interplay between 42 and again will come up, because clearly I think from a WAS 1 perspective there are no issues. From WAS 2 perspective, again there is no payment which is going, right? So there is no payment which is going from WAS 2. Now here clearly I think there is no doubt about it that this is a close connection and everything. So what can there be some kind of a situation where the TTO will say that because of this close connection these funds have gone and therefore there is no interest charge and therefore there is a higher profit which you are taking. So here in this situation, what will really help you is not the benchmarking as done as per the normal STT, because that will really not apply. In those situations, again, so what are those ordinals? You may try and do benchmarking on the basis of the interquartile. That's what I believe. In the Western world, when you do transfer pricing, it's not that average arithmetic mean. Because those interquartiles, median, and those concepts, statistical tools. So possibly in this situation, because STT provisions are not applicable, you may get support from those interquartile rates, etc. In that